Are you worried what the next year will look like when it comes to your income and retirement? Well, a recent survey out says that you are. So many people have recommended taking 4% each year from your investments to cover your income. But did you know that this strategy could fail? That's right. Good morning. I'm David Hollander, your host, and this is Protect Your Assets. For those of you just joining us this morning, people around here, they call me the Sandman. You heard the jingle, and that's because I've been doing this for over 30 years. You can always ask me a question anytime. I love those questions. Had some really good ones this week, particularly with what happened. Email me questions at PYA Radio, PYA for Protect Your Assets, PYA Radio, anytime you like, and I'll be more than happy to try and answer it. So I was just talking about what just happened this past week and all the uncertainty that's going out there right now. And according to this survey, people's number one fear right now is running out of money in retirement. So let me ask you a question. Would you step foot on an airplane if the pilot told you as you're getting on that there's an 86% chance that you're going to land safely on the other end? I don't think so. I wouldn't either. One of the traditional rules people use in retirement planning is something called the 4% rule. This is where you take 4% each year from your investments to try and avoid running out of money during your lifetime. If this is something that you've been doing or thinking about, well, then this show will be for you. Stay with me for this entire episode as we share how, during current times, the 4% rule could ruin your retirement. Now, let's get started. Well, the market did like the election results. And for a brief moment, the S&P 500 went over 6,000 for the first time ever. The Dow closed the week up 4.6%, S&P up 4.7%, NASDAQ on a tear up 5.7% in 1 week. That's why you cannot try and trade politics. You have to stay in it. Stay in it to win it. The 10-year settled in at 430. We're going to talk a lot about that this morning when it comes to your income and what does that mean. We've got questions this week about the bond market. Oil over $70 a barrel, 70.41, and bonds up slightly, 0.8%. So the standouts this week, we were the gainers because of all this. The financial service sector did the best. Regional banks up over 10%. Of course, this is hopes of lighter banking regulations, lower capital requirements, and easier M&A activity. And we saw the small caps and the mid caps benefit, and that's, again, why you need a diversified portfolio. So one of the things I want to talk about is after an election, typically you want to wait a little bit of time and see what unfolds. And it is essential at this point to really look at what you're doing. And if you don't really have a diversified strategy or not taking advantage of these other areas that could do well in this environment, now that the political shift seems to be in hand, give us a call, 866-PROTECT, and find out what you can do, because right now you need a well-diversified portfolio that's positioned and aligned with some of these potential scenarios that are unfolding as we speak. And this can help you achieve a steady progress to your retirement. And this past week, we saw the Fed talk as well. And as expected, they were going to lower rates. They did. They cut another 25 basis points. And this came right after the election. They did the half a point cut, which was big. But they did wait until the election. They came out right after and said, okay, we're not really changing what we're saying. We're leaving the door open again for another cut, maybe coming up here in December, because they believe they're going to get close to their 2% inflation target. Now, that happened a lot this week. We had a lot of discussion with folks about inflation and fixed income. And what does that mean? Because there's a trend out there right now that's saying that because of what happened in the election, that there's going to be tariffs, things are going to cost more money. This is what you're hearing about. And therefore, you may want to be getting out of your fixed income. I would just say, wait a minute on that. We don't really know right now. We don't know what they're going to do, and you're probably not going to know until at least the first quarter next year. So just hold on. But what was really interesting was the day of the election, the 10-year Treasury, which does measure future interest rates, had a big move. It was a 14 basis point move in one day. And then the next day, when the Fed finally came out, it dropped. So just be aware of that, and don't trade on your fear, because that's immediately what happened. We started getting called. Should I get out of this? No, just take a breath. It's okay. The Fed is trying to pull off a soft landing. I made the airplane analogy. Would you step on the airplane? So right now, the Fed is definitely in control of the controls, and they're trying to land the big, massive jet that we call the economy, inflation, that you throw whatever you want at it. They're trying to land it right now softly, and it looks like they're doing a pretty good job. So just hang in there. That's what I can tell you. All right, so we're going to talk about this 4% rule today. What is this? This is something maybe you came across where it said, look, you have a set amount of money, you pull out 4% each year, and you live off of that, and that should work all the way through your retirement. So there is some problems with that. And so today we're going to get into what that could mean, how that could affect you, and what you should be thinking about right now while rates are where they are at. And we're going to talk about that today. We're going to talk about some rates that are out there. Again, this is as of this past week. These things change, so make sure you check what's going on before you do anything. But we'll just talk generally about the themes of the market and what's going on and where you might want to be looking right now if you're trying to create consistent income in retirement with everything that's going on, because you should have your own plan just for you. So let me ask you a question. Are you considering retiring anytime in the immediate future? Well, a lot just happened. And so I would like you to stick with me this morning as I'm going to share some specific steps that you might want to be considering right now. You are listening this morning to the Protect Your Assets show. I am David Hollander, the Sandman, and we will be right back. Welcome back. I am David Hollander, also known as the Sandman, and you are listening this morning to Protect Your Assets. And I don't know if you're an Eagles fan, but if you are, I would highly recommend seeing them at the Sphere. Amazing show. Well, in any event, people around here, they call me the Sandman. I'll tell you, it was quite a week. We had a big election, and of course, the Fed coming out right after. So it was quite a week in the market. We're going to try and make some sense of that this morning, particularly if you're counting on income in retirement or you're trying to create income in retirement. This morning is going to be about that. That's what we're going to be talking about. I'd be willing to bet that you would not step on an airplane if the pilot told you there was an 86% chance that you would land safely. Yet many retirees are told to follow this outdated rule of thumb, which is called the 4% rule, when they withdraw money, and they don't realize that they could be running the risk of actually running out of money at some point in the future. For those of you who aren't familiar with the 4% rule, well, it says this. It says that you won't run out of money if you're retiring as long as you withdraw approximately 4% from your portfolio, adjusted for inflation, each year. Now, this rule was created in the 90s, and it was based on stock and bond returns over a 50-year period of time. What period, do you ask? Good question. 1926 to 1976. And sure, it made sense to many for a while. But as we know, times change, and they sure have over the last couple decades. And you saw that this past week once again. Change is natural. Change is human. And so is investing. For one thing, the 4% rule came about when interest rates were much higher than even today. Back then, you could get a treasury note pretty easily that was paying above 6% or more. Now, I'm looking at the bond market from this past week, and this looks like it was midweek, say the 6th, closing again. This is this past week, November, so don't hold me to this today, because these rates do change. All right, I'm just giving you an idea. I can tell you where the 10-year closed on Friday. The 10-year closed at 4.30. Okay, 4.30 is not 6%, right? There's a difference there. That's all the point I'm trying to make. Is rates back then were higher, and in some cases much higher than they are today. So when you look at rates today and you think about this rule, just think about that. What was that rule trying to say? Well, if you could get more in fixed income that was safe and fixed, well, of course, it's easier to create a 4% withdrawal rate. But when you look at the 10-year that just closed this Friday at 4.3%, will that work? Will that keep up with inflation? No, of course not. So, and then again, I'm just trying to help you understand this. You had the Fed talk this week. Once again, Chairman Powell came out and spoke to all of us. What I did take away from it was that they're not planning on raising rates substantially over the next couple of years. That's the point. And if you go look at the bond market like I do every morning, you'll see the same trend. You'll see that the 3-month Treasury right now is the high point. And as you go out over the curve, 6, 9, 1 year, 18-month, 3-year, you'll see the trend of the interest rates are down, going down. And so when Chairman Powell says that they are potentially going to lower rates here in the future, depending on conditions, of course, well, you should take them seriously. And think about maybe why some other things you're reading are saying other things. Think about it. So now that the 10-year is where it is, and there really aren't any signs that it's going to be rising significantly in the near future, what should you be doing? Well, what a lot of folks are starting to do is they're starting to look at stocks. In fact, we had someone this week immediately. I mean, this is the same person that always asks these questions. And I say, please just take the risk-alize appropriately. Answer the questions, because you're getting in your own way. And what it means is this, the folks are looking at the stock market. Now, if you listen to the market segment, and if you didn't, go listen to our podcast, find the market segment, and you'll see where I was talking about the market this past week. And of course, as I mentioned, the S&P 500 got to 6,000, did not close above 6,000, which is important. We closed at 5,996. I didn't think I'd be saying that this year, but here I am saying it. 5,996. And of course, that year to date is up 25.7%. That's significant. That's a big deal. That's a big year. That's a big gain. And so this person who loves to look at the big market and says, wow, it's up so much. Why aren't I up so much? Because you're in bonds. You wanted low risk or lower risk. There's always some risk. In fact, you could take this much risk. My point is that stocks and bonds are totally different. So a lot of investors are chasing that higher yield now. They're saying, oh, it's 25%. I want that. But then when it goes the other way and drops 20% or more, you don't want that. You don't want to be anywhere near that because it reduces your purchasing power immediately. And then you panic and sell. So take a breath and look at what you want. What are you trying to do there? Stop chasing the stocks because you really don't want more risk. This type of strategy may work out while the market's good, of course, or even if there's an occasional dip. But if your plan is to withdraw 4% from your retirement account every year moving forward. And there is a big time drop in the market like we saw in 2008. Remember 2008? I just want to remind you about that. You had 2008, you had 2009, we had 2010. Took a while for things to start to come back. The other very real issue right now, which again, we do not know. So don't try and think of like, oh, I'm smarter than the guy. No, you're not. So we don't know about inflation. We don't know where that's all going to go. So when the market drops, and I'm saying that because we all know it's a matter of fact at some point when the market drops, if you're retiring now or you're early in retirement and you continue withdrawing the same amount of money each and every month to live on, what is that going to do? It's going to force you to sell some of those stocks that you've purchased that were doing so well, and now they're not. And you need the money to pay your bills. So you're selling off when things are down in the worst possible time. And it could go on for years, and just like it did in the 2000s. This pattern is called the, write this down, death spiral. That's because even if the market eventually recovers, your portfolio might not. You may have to reduce your withdrawals. That means you're not going to have as much income each and every month. And guess what? That means your lifestyle will change. And the worst is you could literally run out of money. I'm working with someone right now who I met on a trip. He did very well. And now he's worried about this because his advisor didn't do his job. It's called the death spiral. Look it up. And if you're lucky enough to live longer than you think you will, then you'll need to add an increased longevity expense and protection to make sure that you don't run out. So, what can you do? Well, are taxes going to go up? This is a great question. We know right now that the current 2017 Tax Cut and Jobs Act, it's going to expire at the end of next year. This is a fact. We've heard rhetoric that they may continue that. They may push that out. And you know what? It looks like it's possible, but it's not certain. And if you go look at what the debtclock.org says right now, you'll see the reality. So you have to ask yourself a question. Is your lifestyle at risk right now? What if your portfolio doesn't produce enough income in the next 5 years to cover all of the expenses that you have? You know, the ones that come out of nowhere. How are you going to cover those bills? What are you going to do? Where will you take the money from? Hey, call me right now. Let's talk about this. We've been doing this for over 30 years. We have an attorney, we have tax people, we have CFPs here in this office to help you plan better. But you have to pick up the phone and ask. 866-776-8328. 866-PROTECT. We're here right now answering the phone to talk to you and help you. 866-776-8328. Coming up next is time for our popular They Say segment, where they say if the 4% rule worked all these years, why won't it work in the future? You don't want to miss this one. You're listening to Protect Your Assets with me, David Hollander. We'll be right back. Welcome back. I'm David Hollander, also known as the Sandman, and you are listening this morning to Protect Your Assets. And with all the activity this past week, it was quite a week. I know the investing world can be complex, intimidating. You have questions, you become frozen, you may make mistakes, you might miss out. So that's why we're talking about it this morning. We did have some folks this past week who were asking about with all this moving around, particularly in the bond and equity markets as a result of the election, and then the Fed taking action. What should we do? And when you see the stock market, the S&P 500 get to 6,000, finish up this past week up 25.7% year to date, you start wondering, well, wow, am I missing out on something? Maybe I should be doing that. It might cause you to make some mistakes. And so think about this right now. If you're looking at trying to create more income in your retirement, then you've still got some pretty good rates that are out there right now. And we did look at the market. And as I was talking about, the 10-year closed Friday at 4.3%. And as we were looking at yields on Wednesday, when the outcome of the election was looking like it was happening, and then you saw the bond market reacting to that, and rates were starting to go up because people were concerned about the tariffs and inflation, all this sort of rhetoric that was coming out. And so you started to see a pretty big spread. In fact, what I'm talking about is on corporate bonds, things called junk bonds. The difference in yield, or what they pay you, was almost 400 basis points. Think about that. If you get 4% more by buying a lower quality, if I could get a bond that's got lower quality, it's not the same ingredients, say, but it's paying me, should we do it? Okay, that's a great question. And so this was the question. And you need to understand, like, when you buy bonds that have lower ratings, there's probability that something could happen, that they could default, that you could literally lose all your principal. And so to pick up 4% more each year, but to lose 100% of everything, is it worth it? Probably not. Particularly if you're about to retire and you don't want to go back to work. Why would you do that? The other flip to that is another person we were talking to this week had a lot of their net worth tied up in their company stock. And as we know, this past week, some of these stocks went up significantly as a result of the election. They weren't worth anything about a month ago. I was sitting there yesterday having lunch with someone, and he said to me, I just made 400%. And you could just see it. I've seen this so much over the last 30-something years. You know, you have all this paper wealth, we call it. And you're feeling pretty good about yourself. And maybe you should take some off the table and lock in some of these fantastic rates that are out there. I'm not talking about junk. I'm talking about quality. I'm talking about investment grade rated tax-free bonds right now. So do you take 4.46% tax-free, or do you take 5.8% taxable? That's the kind of questions you got to ask yourself right now, because you can get these kind of rates out there. They're still there in quality. You talk to us, find out what that means exactly. I'm just talking in theory right now. But you got to ask yourself the question, should I be drawing down tax-free right now or taxable? It really depends on how much income you make and how much taxes you're going to pay on that now and in the future. And who's backing it and what's going on there. You got to look at all of that before you make any decision. Please do that. And in some cases, if it's not an IRA account, tax-free might make more sense for you. If it is an IRA account, what that means is even if you earn that interest, it's going to be tax deferred. So you're not going to pay any taxes on that until you take it out. So that might be better. Just really depends on your situation. But these rates are out there right now. Now, there's another one, which I'm going to talk about in the next segment, but I'll just tease it here a little bit. And this has to do with creating, if you're, say, 65 or older, over 7% in income that you can count on. Remember, I was talking about how where you might live longer than you think, and it's possible to burn through all of your principal over that time? Well, there's things out there right now with these kind of rates, and remember what Warren Buffett said, if you can get 7%, you're doing pretty good. Go look that one up. And you can do that. You can actually create that right now. We'll talk about that a little bit in the next segment. But anyway, that's out there. So I'm going to save that for the last, because that is, in my opinion, another great way to build some income in retirement. All right, now it's time for one of our fan favorite parts of our show, our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice that they say. All right, so here's one they say. In fact, I heard it this week. They say that if you withdraw 4%, it's been working so well all these years, then why won't it work now as we move forward? Great question. And so let's go through that. First of all, the 4% rule, as I was talking about, it's almost 30 years old, and so much has changed since then. Years ago, a top retirement researcher wrote about the differences between the market environment when the 4% rule was created and now. And it's been over 10 years since Wade Pfau, you might want to read this, PFAU, one of the top experts in retirement research. He wrote a column for MarketWatch urging readers to say goodbye to the 4% rule. In that article, Pfau suggests that the rule, which actually is more of a theory, made too many assumptions based on old numbers, that it didn't necessarily translate to today, or what he called modern investing. Then, a few months later, in 2013, Pfau and fellow retirement specialists Michael Fink and David Blanchette published this study. The 4% rule is not safe in a low-yield world, further demonstrating why advisors who base their clients' withdrawal plans on historical data could be creating a problem. Since then, the topic's been debated on just about every financial forum out there. We've talked about it. And so not everyone believes that the 4% rule must be completely discarded. But I think a lot of folks who specialize in this would say this: at most, use it as a guideline, maybe a starting point for determining what's appropriate for your needs, and look at what's backing up those payments. Because I still heard from them this week where they're using this without any question. Well, it worked for them. It's going to work for me, or it's worked for me all this time. Doesn't matter now. It's sustainable. But is that really true? You really need to dig into that and look at it and see if that strategy is going to work. Because like I mentioned, maybe the things that are paying that or have been paying that might be changing now with all the changes that are potentially coming. And why do you want to take that risk? Because according to this study, when you calibrate the market environment as they did, it caused the projected failure rate for retirement accounts, get this, to jump to 57%. 57%. Do you want to take a 57% chance that your withdrawal strategy won't work? I don't think so. So that's why you could pick up the phone right now and you can get a second opinion. You can find out what your strategy could look like, where the failure might be, and you can do something about it. This is painless, it's complimentary, and we do all the heavy lifting for you. So call me, 866-PROTECT. Get your own reports, customized to you. You can see your own numbers. This is for you. 866-776-8328. Call that number right now. Get your own custom report, 866-PROTECT. It's time for a quick break. When I come back, what is the one thing you can do to make sure you have more income each and every month right now? The answer is coming up next. Stick around. We'll be right back. Welcome back. I am David Hollander. People around here, they call me the Sandman because I help you sleep better at night. And this past week, thank you. Thank you for asking all your questions as all the uncertainty was unraveling. And we'll continue. And I am here to help you keep more of what you have and stop making those foolish mistakes. It was a tough week. So I'm glad you hung in there. Thank you for asking the questions. And that reminds me, if you missed any of the show today, we were talking all about the subject, what just happened, what you should do about it. Go check out our podcast, which will be posted Tuesday. You can see it by going, say you're on Spotify, just type in Protect Your Assets, and you will see the market segment, and you'll also see the show where we've been talking about today, the 4% rule, but what it actually means today with all the changes that just occurred this past week. On today's show, we're sharing how this 4% rule could ruin your retirement. And in the previous segment, I was talking about a study that came out, which was sort of jarring with the percentage, 57%. And there's other studies out there, but the bottom line is you probably wouldn't do it if you weren't sure that the other side wasn't going to work out. I use the airplane analogy. Imagine that. You're getting on a Southwest plane. As you're crossing the threshold, the captain's standing there smiling at you. How you doing? Oh, there's an 86% chance we're going to land in our destination. What? I think I'd turn around and walk right off. So maybe in your retirement, you're thinking about some consistent paychecks every 2 weeks because let's face it, once you stop working, those are going to stop coming. And so if you have a birthday coming up, I got a present for you this morning. These are called FIAs, fixed indexed annuities with income riders. That's what I'm about to talk about. This is how you can create certainty. Again, these payments are backed by the claims paying ability of that issuing insurance company. So make sure you look that up and know what that means. But there is one carrier that we work with that has the following. They have birthday increases by 10%. And if you wait up to 8 years, you could potentially double the amount of income. Well, let me just start with that. So what you do is, we have this chart, we're happy to share this with you, is if, let's say, you're 65 years old and you're going to start this immediately, as of right now, this is showing 6.88%. And if you wait a year, it could be over 7.5%. And depending on when your birthday falls, you could get over 8%. So just think about that. If you could create 6, 7, or 8% insured, backed by this claims paying ability of this particular company, which we'll share all that with you, that could generate 6 to 8% for the remainder of your time, because that's what these do. As long as you're living and breathing, even if you run out of money, they will continue to pay you as long as they're around. Think about that. Those are some pretty healthy, decent returns. So if you could take some of your retirement and create your own pension, that's what this is, and it could have these sort of returns, that might be of interest. And depending on how you structure this, maybe you got 3, 4, 5 years to go before you retire or before you're going to turn on that next bucket of income. And if you're like some, believe inflation's coming, they're going to be raising tariffs, there's going to be more need for more income, then you might want to start putting something away now. So say 2, 3, 4, 5 years from now, if you just want to flip that on and you want to see 8, 9, 10%, you could, depending where you fall in this category. Again, you have to call us and figure out how this works for you, but it's possible. So how do you do this? Maybe you haven't heard this before. You have to pick up the phone. You have to call us. Find out how this affects you. 866-PROTECT. Talk to us right now. We're live. We're here today. 866-PROTECT. 866-776-8328 to talk to a live person right now. Get a complimentary review. We'd love to help you. 866-PROTECT. I'd like to give a big thanks today to the team, the Protect Your Assets team, for putting together a great show. executive producer, network manager, Kevin Renfer, and all my fabulous producers back there. Lee, Dylan, Lucas, Raph. Thanks, guys. Because without my team, I'm just another pretty voice on the radio. You have been listening to the Protect Your Assets show. I am David Hollander, also known as the Sandman. Go out and make the rest of your life the best of your life.